Hi, this is Randy Finney with Right Side of the Chart, and this is a closing market wrap for Tuesday, January 7th, 2020. There's not a lot to report, but I figured we'd do an update. There's a couple things to point out that I didn't point out in the closing market wrap video yesterday that I pointed out to subscribers in the video earlier today. In that video, it was all inclusive, covering a lot of different asset classes: treasury bonds, stocks, gold, Bitcoin, natural gas, and the US dollar. So what we'll do today is, of course, we'll keep this one just an end of day general market wrap, US stock markets only. And again, it's almost becoming, it seems like it's becoming mundane to even do these updates because the market's been slow grinding higher. However, I've done this long enough to know that it's from those extended period of low volatility when everybody just gives up and gives in to the fact they think the market's going to go up forever. That's when you usually get the bangs. You get these corrections that start out with a bang. And as I said, the risk reward for weeks now and even months hasn't been attractive to me on the long side. For example, here's the peak back in last fall, September right there. Was that September or August? I'll measure it back. We're up about 9.8% or so, and that's 1.3 years, so 15 months. And the S&P 500 has gone up about less than 10%. Just to kind of put it in perspective, today we had one trade we entered this morning, BYND, Beyond Meat. We hit our first target in less than 6 hours, and we made 9% on that trade. So here, people are cheering the stock market, and it's going up. It's a strong market, but what they seem to leave out in the headlines, the strong gain in 2019 was the fact that we were coming off one of the biggest drops in years, which started right there. So the clock conveniently started at that point right there. And again, the market's and you can go back for a while here. It's in a bull market, it's going up, but it's kind of slow grinding higher, and the divergences, everything remains intact. But again, that's stuff I've talked on ad nauseum lately. Let's just hit the key levels here and things to watch for, because the market sooner or later will perk up. As I mentioned recently, we've had this pretty tight price compression right here. It goes back to December 16th right there, and that range, that very tight range, is about 1.5% or so. So again, that includes all the candles. We have a little brief spike above it right there, a little failed breakout. And so what I covered in today's earlier video is you were likely to see the next near-term trend when we get a break of this consolidation range. We're going on a good 3 weeks right now of very tight price compression in a sideways range. So the market's gone nowhere, really, not just since the first of the year, but all the way back to mid-December. And what happens there, and again, this is what I covered in the earlier video today, is the indicators start rolling down, the momentum indicators. You might say, well, wait a minute, Randy. The market's gone up from that period of time, from December 16th. We're actually a little higher. Yeah, we're in a 1.5% trading range, but we're slightly higher. So why would the indicators be going down? Well, the way that works is, the analogy I use, it's like you throw a stone up into the air. It's going to go up, and then for a while there, it seems to just suspend and almost stop in the air. And that is when you have a lot of upside momentum going into a trend, and all of a sudden you start turning sideways. These are momentum indicators. When they're pointing up, simple sideways trading will bring them back down. So what that did, what the net effect so far has been, is number one, it keeps those divergences in place. They're not burned out and not at risk of being burned out. And you can see them clearly on the weekly time frame as well. And what it did as well is it's turned down and given us a bearish PPO crossover. I've covered this recently. Here's a histogram. If you don't have a PPO in your chart, you can use a MACD, very close cousin to the PPO. And so with the histogram, I like to use these what I call hills. The histogram will indicate when you have a bullish and bearish crossover. Here, let's try to Let's do this. Let's turn off all the lines on the prices. Let's pull up this PPO right here so we can see it really clear. And you can see we have the PPO line in orange and the signal line, which is also the 9 EMA. It's your signal line. And when the orange line crosses down below, that is a bearish crossover, like you had right here. And when it crosses back above, that is a bullish crossover, such as you had, for example, right here. And the histogram just gives you a visual representation of how far apart these two lines are. So when they cross, they're going to cross the zero line, this solid line in the middle there. And what it does, it helps to find trends. Bullish crossovers, especially like when you have clean separation between the lines, which gives you a big hill. So I look at these hills, and there's your trends. And again, we'll do this like I did today in the video earlier. Let's pull this down a little bit and show you that those PPO hills, like I like to call them, tend to define bullish and bearish trends. You can see prices were in a bullish trend above. I flattened things out here so the corrections don't look so big because it was a big run off the lows, but those were tradable, decent corrections. And again, you can see down below the PPO does a pretty good job of telling you when the trend is bullish or bearish. You get the bearish crossovers, which we just had. Now I did about last month, I did mention we had those crossovers trigger. That proved to be, we'll call it a whipsaw signal. We had a correction, a little drop, and it was more of a correction in time than in price. But again, sometimes you get the little whipsaw signals first and then the actual trend change. For example, we were on a bearish sell signal right here. You had the PPO make a bullish cross, but it turned to be a fleeting whipsaw signal. But right after that, you've got your solid buy signal there, at least on that trend indicator, and it told you up until about that point or so, you can see it down below, the trend was bullish. So this was a whipsaw signal, and that often happens too, especially when the lines start to flatten out. When I say flatten out, when there's not a lot of clean separation. This is clean separation, there's clean separation, there's clean separation there and there. Not so much here. So we did get a whipsaw signal. Like I say, there's not a single indicator, trend indicator included, that does a perfect job. But this one's pretty good. And as I also mentioned earlier today, is that you can almost take a look, well, you can take a look and see when these indicators are likely to flip. You can see the histogram kind of coming up there. You can see it coming down there. So you can almost anticipate when you're going to have those signals by looking at the MACD. So there they are there. And then the final takeaway is, let's turn back on the lines here and look at the here's the PPO up above. Here's your divergence lines right there. And again, each of these divergences played out for corrections. Small divergences, smaller correction. They were each divergent highs, corrections up above. I know I've flattened out prices. But what you can look at as well is you can use the histogram and see the divergences there. The histogram making these series of lower lows as well. And that is negative divergence. So there it is. And that's why I do these videos even when it seems like the market's falling asleep at the wheel with a slow grind higher, because you have to have these levels ready in advance. You have to be ready to move and then jump on something, just like that breakout today in Beyond Meat. It was up at one point, up over, I think it was about almost 14% at the highs, and we hit our first price target. And as expected, the reaction, that's why I list multiple targets. We reversed from there, so it was a quick chance to get out. But you got to get in and get out of these, and the same thing will happen, especially when the market's finally correct. Because as I say often, one reason that I just love shorting stocks as much as I love going long is that stocks tend to fall a lot faster than they rise, and you usually wipe out days, weeks, or even months of gains in just a matter of days or weeks there, and sometimes very short order. So you saw it back here, and you just go back at any point in time and you will see that that tends to be the case. The stocks often fall much faster than they rise. And so again, it's been a resilient trend, but we did trigger those sell signals last week that I was looking at a couple weeks ago, really, on SPY and IWM. They broke down first, but as I said, the big one was QQQ. When QQQ finally broke down right here on that red candle, that put I put out a post. We had the first decent sell signal on the markets, and that sell signal remained intact. We had a little kickback rally. Sometimes you break trendline support, and that's it, and you never look back, and the correction begins. And then sometimes you go in and you back test, and that's what we've had so far, is simply a back test of the trend line that only extended the divergences. It did not negate them or take them out. It simply extended the existing negative divergences that were in place. And so the levels to watch remain the same ones I covered yesterday. Well, we have 214.34 right there, 211.42 should really open the door for a test of the top of that gap at 209.11 and then backfill the gap at 207.46. SPY level I continue to watch right now. Well, we have that recent consolidation range right here. You can see there in SPY. So really that should do the trick, I think, a pop below 320.31. But don't trade SPY in a vacuum. You also want to see QQQ break down, because let's just say, for example, SPY broke 320.31 and even broke this 319.48, which is a level I have. That's the top of the gap there. But at the very same time it did so, QQQ happened to come up on a pretty good support level. You could get a reversal. So keep an eye on both of them. Those are the large caps. I've covered the small caps recently. We won't get into that today. Let's just watch these, because these guys will determine where the market goes. And yeah, so those are the levels to watch. And let's see what else. And then, of course, there's the futures. I like to keep an eye on the futures. I like to trade the futures. Here we go with the trend line. There's our 60-minute uptrend line. There's the impulsive breakdown. Simply extend that line like I did on QQQ, and you can see that was simply a breakdown and a back test. And you can see volatility starting to expand. So the market's waking up right now. It's not going up, it's not going down, and hey, maybe we'll just continue up. Maybe this is another correction in time versus price. Like I said, indexes, especially at this point in time, are a small part of my trading. I don't have very large positions, but I'm still holding my shorts for now. There's not anything I've seen here that tells me that we're not going to go down and hit those additional targets down here, and at least looking for a minimum move down here to about 85.93, and quite possibly move down here to about 84.85. In fact, the more we chop around here, and if we do get a solid break here, you can see that's pretty good support here, about 86.94. That could be a pretty nice topping pattern. I don't try to force things. Sometimes I get questions, hey Randy, is there a head and shoulders? Traders love head and shoulders because they're one of the most recognizable patterns. Maybe. You typically want to see them on the longer term time frames, the daily and the weekly charts, and you want to see them lasting, forming over a matter of weeks or months. But I do see them play out once in a while on a 60-minute chart. So either way, it's support, whether you want to call that the neckline of the pattern or you want to have an upward sloping neckline. That's actually probably more accurate there on the futures. But to me, I just want to see this, this recent consolidation range. I want to see a downside break, and then if we get that, I might add to my positions. Otherwise, I'll, like I've been saying for a long time, there are much better fish to fry elsewhere. I mean, besides the BYND trade today, we had 2 or 3 other trades up double digits today alone. We had what was it? Riot was up. I think that was up 14% or so. Actually close to 15%. So we were up 10% on it yesterday after the break. Another 15% today. Overstock long trade was also up double digits today. I'm sorry, our overstock trade was up at the highs, hit our first target, came right into just under our bottom of our first target zone, and then reversed there. It was up almost 9% at the highs. It was our GBTC Bitcoin long trade. That one was also up today by, let me see, over 12%. I mean, so there's 3 trades alone, 3 or 4 trades that have done what the stock market's taken 13 months to do, and we did those all just today, and that's again on top of gains yesterday. So, the market's going up. It's in a slow grind higher. Again, I do these videos at some point. It'll wake up where we'll have some, quick actionable trades and swing trading opportunities. And again, if you are bullish and long, you want to buy the dips, I do these videos. I show you where the key levels are. You can step in and buy there. But to me, nothing has changed in weeks or even months now. The risk reward is just not favorable. The trend is bullish. I recognize that, but the upside is limited. And it's been very limited. We've only gone up what year to date? Well, flat year to date, of course, but as I just showed you, going back, from mid-December, last 3 weeks, the market's gone nowhere. And again, I look at everything through the prism or through the lens of risk versus reward. What is the next 5 or 10 or 15% likely? Is it likely to be to the upside or downside? And I still believe that to be to the downside. So first things first, let's just see what happens. Let's see if these levels break. If so, we start to get some additional sell signals or bearish price action. I'll add to the index shorts, but looks like it's coming. But then again, it's looked like that for a while. These divergences continue to build, and we've had some corrections along the way where the corrections were more so in time than in price. But this looks a little different to me, and so we'll keep an eye on this, and I will update you guys tomorrow if there are any notable developments of the broad market. Otherwise, we may skip an end-of-day general market wrap and focus on, trading individual stocks, commodities, futures, and other niche things that have much better risk-reward profiles. This has been Randy Finney with Right Side of the Chart. I hope you enjoyed it.